So we just heard from the Federal Reserve. There is no rate hike in June. Finally, the streak of rising rates is over for now. The market is reacting negatively. It seems that the big reason is that the Fed has released a projection along with this report, as they do every other meeting, that by the end of 2023, there will be another 2 rate hikes. So, in other words, the Fed is pausing its rate hike cycle, but it's not only saying that they're not done yet, but now they might be a little bit more aggressive than originally planned. The projections for 2024 and 2025 are higher as well. They do imply some rates will come down, so that rate cutting will start maybe in 2024, but generally higher projections than expected. So, Tyler, as an investor, what do you think of this news? Why is the
I can't
market
speak
down?
to
Does
all
it mean anything to your
investors,
portfolio?
but
Anything like
to
that?
me, I'm not wholly surprised at this. Despite we have seen some lower prints for inflation numbers, we're still seeing a relatively strong job market. And one thing that has popped up as of recent is there is a lot of construction going on in the United States, especially things related to like the CHIPS Act, the Inflation Reduction Act, some infrastructure bills. There is a lot of investment being made because of tax credits, and as you know, when you have that, you have a strong job market. The things like that are going to be inflationary pressure. It's really hard to get around that. And so a lot of those things are going to continue to have that inflationary pressure. And clearly the Federal Reserve thinks that it is enough of a pressure that it needs to continue on its journey to get back to that target 2% inflation rate, which requires higher interest rates. There's been a lot of talk. I know that we had some predictions at the beginning of the year that we were going to see lower interest rates, but lower interest rates from the Fed would imply that we have gone below inflation, and we have also to kind of juice the economy. And there doesn't seem that the Fed feels it's necessary to give it back. And so when you have that sort of condition, I'm not wholly surprised for it, and I've been thinking about it a lot in my portfolio in terms of making very, very selective moves. So with this news, it kind of reinforced, I think that's something that they should consider, is that if this high interest rate environment is to stick around longer than expected, people need to be more discerning when they're making their investment decisions, because the hurdles that you have to jump over with your investment are just higher.
Yeah, I would agree. I like what you said, where there hasn't been enough bad news. I think you're absolutely right there. I think that as long as there's not enough bad news to really justify the Fed taking notice, they're going to err on the side of controlling inflation as opposed to keeping the economy alive. I mean, unemployment is still hovering near record lows. The job market is still pretty hot right now. The consumer is still very strong. There's not a, I mean, there's probably going to be a recession, but the odds of a deep recession are very, very low at this point. And I think that's what the Fed's factoring into its decision. As far as the market, they don't care what the Fed's did now, as long as it wasn't anything completely out of left field. Everyone expected the Fed to not raise rates right now, but it's the expectation that the rising rate period, or the higher interest rate period, could last longer than expected. This is likely to trickle into some consumer interest rates, which are kind of tied into this. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.